not be worth. Somebody has net worth less than $100,000. If they haven't fully funded their IRAs, 401k, short-term investors, absolutely. People have insufficient emergency funds, and anybody that might need the money before 59 and a half. So again, a variable annuity is not for everybody, but for a lot of people it may be a viable choice of a place to put their money. Let's talk about 1035 exchanges, because we want to be able to move money, in this case from some form of an existing contract to a variable annuity. We want to move it to another annuity, or from a life insurance policy to a variable annuity. So we want to talk about the instances. If you have an existing contract, you either have a profit, a gain, or you have a loss. Quite frankly, with most life insurance policies, you have a loss. With an annuity, it's possible that you could have a gain that you want to defer. But for life insurance policies, it's almost always a tax loss. So here's again, how can I defer a taxable gain? If you paid $20,000, there's $25,000 in there. So the $5,000 extra is now taxable if you surrender it. So what can you do? If you take the cash value, you'd have to pay current income on this $5,000. If you roll the cash value into an annuity, you won't have to pay taxes on this $5,000 until some future date when you start to withdraw. So the premium is the cost basis. So $5,000 would ultimately be taxable later. How can you save a tax loss? You paid in $20,000 in premiums, but there's only $15,000 in cash value. So you have a $5,000 tax loss. What are your options? If you surrender the life policy, right, just take the cash, then you're going to suffer a tax loss of $5,000, but it's not a tax loss. You don't get to take a tax deduction from this. But if you roll it over to the variable annuity, the first $5,000 in gains, right, you're going to get, if you have here's the exchange, the variable annuity cost basis is $15,000. So when it gets to $20,000, that's when you're going to start making profit. The tax-free growth, you're going to have to pay taxes on that $5,000, or you'll get that tax loss, but there's absolutely no gain to that, if you will. So again, you can save this tax loss, and the first $5,000 of earnings in the variable annuity is ultimately tax-free. What kind of charges and fees? We've been talking about them as we've gone through this. There's a mortality and expense risk charge. That pays for guarantees. There are things called step-up charges. Not every variable annuity offers these, but essentially what it does is it creates a guarantee of upward growing portfolio values. So the guarantee that your beneficiaries are entitled to can grow as the value of the portfolio grows. I have here, it's called a floating floor. The very minimum amount that can be paid to beneficiaries can grow as the value of the portfolio grows. Obviously, there are fund fees and expenses, right? These are institutional funds, so typically they have some lower fees. It's usually a contingent deferred sales charge, so unless you cash these out in the first 8-9 years, there's no other fee. And of course, there is a contract administrative charge. It sounds like there's more fees here than with a mutual fund, and that is true that there are, but because some of these fees are tied to institutional funds, those fees are less than what they would be in a mutual fund. So it is more expensive, maybe 1% to 2% in general, again, depending on the variable annuity company, but I haven't seen much more than 1.5% in difference in value or of expenses between a variable annuity and a mutual fund. So what happens on withdrawals, right? Obviously, the growth is taxed, right? Since it's going to be subject to taxation. If you pull it out before 10%, there'll be less than or equal to, if you're less than or equal to 59.5, there'll be a 10% penalty in addition to the taxes. So So the exception is, what happens if I want to retire when I'm 55? Well, you can set up an account. It's called a 72Q or T or Q, depending on the kind of mutual fund or variable annuity. And you can withdraw these payments. You'll pay taxes, but there won't be a 10% penalty. So you can set that up. The only deal is here, payments have to continue for the longer of 5 years or 59.5. So if you were 54.5, this would be perfect because you have to at least pull it out for 5 years. But if you were 52, again, you would have to make sure you had the payments would go till you're 59.5. If you were 56, it would have to go to 61.5 before you'd be able to withdraw the funds, because it has to grow the longer of 5 years or 59.5. How do those step up in benefits work, right? Let's say we have a death benefit is constant for the first 8 years. So if you were to die in those first 8 years, you get the greater of whatever the value of the contract is, or the total purchase payments. So if the total purchase payments are more than the contract value, you would get that. What about after 8 years? Well, now there is a step up. So now it's the greatest contract value on any anniversary age. So here, at age at number 8, if it's 150,000, if you put in 100,000 and it grew to 150, it's worth $150,000. If you died at 9 years, it would be worth $180,000. That's what your beneficiary would get. But then we kick into an anniversary year, right? That here's the step up, is now they're going to calculate the value of your variable annuity and say, hey, this thing's now worth $230,000. So now this is your new floor. So what happens if the 11th year, the value of your portfolio drops to $190,000 and you pass away? What happens? Well, since there's a moving floor, the value to your beneficiaries, what they would receive is this $230,000. If you didn't have the step up, it would be this $190,000. So it's the contract value, whatever you initially invested, more purchases, if you will, or if there's a step up, it's that step up that gives you potentially greater value moving forward. So if you have if you're 25 or 26 and you have a 401k that you've moved from that company and you want to move it to something, move it to a variable annuity if it has these step-up clauses. Because these step-up clauses, as the value grows, that benefit grows along with the marketplace. So in a couple of years, if it goes up, maybe let's say it goes up by 30%, when it gets to that time, if it goes up by 30%, now that 30% is now locked in. What would happen if it was an IRA? If you move it to an IRA, your beneficiary only gets whatever the market value is. Now guess, these step-up benefits are not free. They cost money. You have to pay for them. What happens when we distribute benefits? What do the beneficiaries get? They get to annuitize the contract, or they could take a lump sum payments. Spousal beneficiaries could elect to continue the contract under his or her name. So you can just roll it over into the spouse's variable annuity. The death benefit proceeds, though, are subject to estate and income taxes. So whatever benefit does pass, though, that death benefit passes through the estate. So there'll be an estate tax. Let's talk a little bit about asset allocation here as we get kind of to the end of this. Asset allocation is the process of figuring out what should I be buying, right? But it looks at asset classes, stocks, bonds, cash. Maybe we slip in something here called government bonds, right? Maybe there's gold or whatever, right? But the problem is, statistically, there was a study done in the 70s that shows that 92% of what a portfolio's return is, right? If you get a 10% rate of return, research says that 9.2% of that return comes from your choice of what these asset classes are. It's not from picking the best things, it's from having the right combination of securities. which makes it actually a little bit easier. Concentrate on the asset classes, then you don't have to worry about necessarily what stocks and bonds you buy. If you're investing in mutual funds, this is a stock fund, this is a bond fund, this is a money market fund. So you can use mutual funds to choose the asset classes, have a professional money manager choose the best things within those mutual funds. That's how you're going to get the best possible return at the lowest possible risk. Here's an investment profile. We could talk a little bit about this in class, right? We're going to go through this, but if you can read through this, right? Figure out what your investment profile is, right? There are a variety of questions. I think we actually have this even in our study guide, but we'll go through this and find out, well, what kind of investor are you, right? Are you an income investor, very conservative? Or are you a high growth, aggressive kind of investor? You need to answer those questions so you know what kinds of mutual funds, what kinds of stocks even to buy. What about rebalancing a portfolio, right? What do? I mean, do you just buy a portfolio and let it hang there forever? Rebalancing isn't a market timing strategy. It says, look, once you decide that you want 60% stocks, 40% bonds, and you want to maintain that, every once in a while you have to go back to your portfolio and rebalance that. So if stocks have now risen, they're now 80% of your portfolio versus 20%, you need to sell off some stocks and put some more into bonds so it brings it back into that 60-40 split. So it's a systematic approach to keeping a consistent risk profile. We talked about some index funds. We talked about those a little bit earlier. I don't think we need to beat this in the ground too much. I think this is actually a repeat. I really don't need to put these in here. This is actually repeated. So the last couple slides here have to do something called variable life insurance. We didn't talk about that much when we were talking in our insurance side. It's very much like universal life, except now we can choose mutual fund types of sub-accounts rather than the interest accounts that the insurance company offers us. Again, all the expenses and mortality charges are deducted before investment premiums even get into the bucket, if you remember that, right? You can calculate your death benefit a couple of different ways. It's a far more complicated investment vehicle than universal life is. Permits you to allocate into some different investment options. You may be able to get a higher rate of return, but there are much higher expenses. You can choose how the beneficiary gets paid. You can pay the fixed level benefit, right? Generally, it's the face value of the policy, but you could also get the face value plus the accumulated cash value. Well, that sounds like good, but this one is even more expensive than that one. So again, there's no such thing as a free lunch, so you always are going to pay for these benefits of these other policies. And again, we talked a little bit about exchange-traded funds. They have the advantages of index funds, and they have trading features like equity products. So they are ETF funds, or essentially closed-end funds that are index-related funds rather than a closed-end fund that's a stock fund, for instance. So that's the end of the product section. The next chapter, we'll talk a little bit more about some strategy.